Is this too good to be true? In this episode, we are going to address indexed universal life retirement hack. So my name's Doug Andrew, and I've been a financial strategist, retirement planning specialist for more than 45 years. I'm here in my radio studio. I've been blessed to have a national radio show for the last 11 years. I also have this YouTube channel where I love to post an in-depth answer to a financial question every single day. And so you're on this page here because you were curious about indexed universal life, or what we call IUL. And it's a retirement hack. So I'm going to share with you why I think this is the superior vehicle, my favorite of 4 resources that most people draw from during retirement, and why it's my preferred vehicle that I would recommend 40 to 60% of your retirement income comes in a tax-free mode out of a maximum funded indexed universal life insurance contract. And it knocks the socks off of traditional IRAs or 401ks, usually invested in the market. When I would help people for their retirement planning, many times I would just simply say, what is your goal? Well, a lot of times they wanted to be financially independent. Some people said they wanted to be rich, but when it really got down to it at the end of the day, at retirement planning, if I ask somebody, so are you still trying to be rich? Would you prefer to be rich or to be guaranteed or assured that you would never outlive your money, that you would never be poor? And they would choose that one. So I said, well, then there's no question that a max-funded IUL is probably the best solution, because most other traditional accounts in the financial services industry, people are outliving their money due to market volatility, taxes, inflation. They have inferior financial vehicles, and so I needed to teach them about why this is far better than putting your money into a tax-deferred IRA or 401k, or maybe into an annuity. So I'm going to share with you the 4 phases of retirement planning and why this is by far the best choice for serious cash for the long run. So I will also ask this question: do you think it's more important that you choose investments based upon which ones grow to the most? Or do you think it's better to choose investments that will generate the most net spendable retirement income that will last the longest? And people go, oh, well, isn't that the same answer? I go, nope. You want to choose the investment vehicles and the strategies that will generate the most money at the time in life you're going to need the money the most. And so it's always not necessarily a vehicle that will grow to the most, because a lot of those rely on the market doing certain things. And if you need predictable income, the market is nothing but unpredictable. So let's go through these 4 phases of retirement planning. The first phase is the contribution phase. This is where we contribute money into accounts to accumulate for our future. So the contribution phase, and you can get tax benefits on what you contribute, or you can go ahead and fund it with after-tax dollars. Now, the next phase is called the accumulation phase. So this is where your money is hopefully growing with interest or dividends or what have you, gains, and that you can get tax advantages as it grows instead of paying tax as it is earned. Now, the next phase, phase 3, is the distribution phase, where you take withdrawals out of your savings accounts. Most people go into withdrawal when they hit this phase because they didn't realize the amount of tax they would start to pay on those tax-deferred IRAs or 401ks. They were always told, oh, don't worry about it now. You'll be in a lower tax bracket then. And lo and behold, they weren't in a lower tax bracket. And they go, that wasn't the smartest way to do this. So the distribution phase maybe is the most important because we set aside money to use it down the road. But then there is the transfer phase. This is whatever's left behind when you pass away and who you leave it to, maybe your spouse, your children, And so many times, many financial vehicles do not have a provision to continue to bless the lives of those you leave behind, because most of us leave behind something that would have sustained us had we lived longer. And so what I did years ago is I analyzed all kinds of different ways to save money based upon those four phases: contribution, accumulation, distribution, and transfer. I found that there were 5 basic methods that most Americans saved money. So here we go. I found that most Americans were saving the worst way. That means they were taking after-tax dollars. They were working and earning money, and of course they would pay tax on that. And they took after-tax dollars and they would put it into inferior vehicles like savings accounts at banks and credit unions earning less than 1%. They're rowing upstream at the rate of 1 mile an hour on their money, while the current of inflation is coming down at 3, 4, 5, 6, 7%. They're going backwards. But see, they were putting their after-tax dollars into the bank or credit union or even a mutual fund, and then every year they would get a statement and they would have to pay tax on the interest or the dividends. That is the worst way to save, taxed as earned. I can prove it to you because a dollar doubling every period for 20 periods will grow to $1,048,000 if it's tax-free. If it's taxed as earned in a 25% bracket, it's only worth $72,000. If a dollar doubles to $2 and you pay tax of 25 cents, you only have $1.75. $1.75 doubles the next year to $3.50, you pay tax on that. See, this is how most Americans save. You'll only have $72,000 instead of $1 million. In a 33% bracket, you'll only have $27,000, not $1 million. 2.7% of what you could have had. And yet, that's the most common way Americans save. Now, the next would be tax deferred. You take after-tax money and you put it into a tax-deferred investment. The most common would be an annuity. And an annuity just simply defers until you take it out. And when you start taking income, it's taxed LIFO. That means last in, first out. So if you had $500,000 in there, and let's say it's earning 10%, most annuities don't pay that much, but let's give them the benefit. 10% on $500,000 would be $50,000 a year. But see, that $50,000 is 100% taxable, even if it's not an IRA or 401k, because the last money you're earning, the 10% interest on the $500,000, is the first money coming out. Last in, first out. And so you're taxed the rest of your life until you start depleting the principal. And most people don't want to do that if they can help it. That's like if you were going around a racetrack and the goal is to have $1 million, the $1 million dash, putting your money in taxes earned investments would be like crawling. Putting after-tax money into a deferred annuity would be like walking around the racetrack. Now, many people get convinced that an IRA or 401k or a Roth is a good way to go. A traditional IRA or 401k would be like jogging around that racetrack. You're using pre-tax dollars around the first part of the race, but at the end of the race, retirement, now you're running against the wind. You have to pay tax. And people didn't realize they would be in a higher tax bracket. So it's like jogging with the wind at the back at the beginning of the race, but at the end of the race, you're having to pay tax on all that, and people are outliving their money because they never dreamed they would have to pay that much in tax. If you have a Roth, that's like jogging with the wind at the back at the end of the race. You fund it with after-tax dollars, but you enjoy the money tax-free. It accumulates tax-free, and it's tax-free during retirement. I could prove to you mathematically that if you earn the same rate of return on the exact same amount of money in a Roth as an IRA or 401k, there's no difference if you think tax rates are going to stay the same. But if you're like most Americans and you're convinced tax rates will likely be higher in the future, which most people, oh no, taxes will likely be higher. If they go even at the lowest level that the General Accountability Office estimates they'll go to, like 50% taxes, the Roth will generate 33% more in net spendable income than a traditional IRA or 401k with the same amount of money, same rate of return. And yet 91% of Americans are duped into putting money into traditional IRAs or 401ks. Now, having said that, I don't own an IRA or 401k, never have, never will, but I don't own a Roth. Never had, never will. My favorite vehicle is called the Laser Fund, Indexed UL. And the reason why I call it a retirement hack is because it has the two benefits of a Roth. You fund it with after-tax money, but it accumulates tax-free. You can access it tax-free, but I have 4 additional benefits that Roths do not have. So I am sprinting around the racetrack. I will hit my goal of $1 million, generating the average that I have for the last 25 years, 10.07. 10% on $1 million is $100,000 a year tax-free. Most IRAs or 401ks only generate about $40,000, a 4% payout if it's in the market. What would you rather have, $40,000 and have to pay tax on the 40? Or would you rather have 80 or 90 or 100,000 tax-free? But see, I can do that with the max funded IUL with 4 additional benefits, and that's why I call it the retirement hack. Savvy CPAs, tax attorneys call it the rich man's Roth. You don't have to be rich to have one, but see, rich people can't own a Roth. They make too much money. So let me summarize this with the key takeaways, the 4 benefits it has and why you are sprinting around that track and why I call it the retirement hack. What are the benefits? When I use a max-funded IUL, and I affectionately call it the laser fund in my most recent book, I'll show you how you can get a free copy of this book here in just a moment. I can accumulate my money tax-free and access my money tax-free. I mean, that's been grandfathered in the Internal Revenue Code for more than a century, long before Roths came around. But I also have 4 additional benefits. I can put in a large sum of money, like $200,000 or $300,000 if I create the account to accommodate that. You can't do that with a Roth. You can't put in that much money. You're restricted on how much you can put in, a certain percent of your income. But get a load of this. If I put in $300,000 and I next year need $250,000 back, or even 4 days later after I put in $300,000, if I need $250,000 back, I can access the money for any reason. There's no IRS penalty for doing that. I've had people in their 30s retiring with $1 million, generating $100,000 a year of tax-free income. One 35-year-old has $10 million, generating $1 million a year of tax-free income. He didn't have to wait till he was 59 and a half, like a Roth. Okay. But see, if I could put in $300,000 and I only put in $30,000, in future years I can make up for the $270,000 that I did not put in there. You can't make up for lost years with a Roth. Once the year is gone, you cannot make up for years you didn't put in what you could have put in. And so I can have flexibility, put in large amounts. I can make up for years I don't. I can access money. What's the 5th advantage? Well, I can use indexing so that when the market goes up, I can benefit, but if the market crashes, I don't lose because my money in an indexed universal life is linked to the market, but my money is not at risk in the market. And that's why I have been able to average 8, 9, 10% rate of return on my indexed universal life contracts for 25 years now. But when we talk about at the end of the day, when you die, the 4th phase, transfer, there is not a Roth around that will blossom in value when you pass away. Every million that I might have in a laser fund, if I died tomorrow, I'm 68, would blossom to $2.5 million and transfer totally income tax free. There's not a Roth around that'll do that, and people ask, how much does that cost? Nothing. It's really paid for with otherwise payable income tax that you would shell out unnecessarily on an IRA or 401k. So if you're getting the picture, this can knock the socks off of traditional retirement savings accounts like IRAs or 401ks, and that's why I call it the retirement hack. If you want to learn why and how, I'll tell you what, this is my 11th book. It's 300 pages containing charts, graphs, explanations, 62 actual client stories and examples. And I want to gift this to you absolutely free. The 300 pages are actually 2 books in one. This is Left Brain, this is Right Brain. And you pay $5.95 shipping and handling, and I'll send you out a copy. Go to laserfund.com, laserfund.com, and get a copy and begin to learn. And then check out some of the other questions that are often asked about indexed IUL, and you can find out those answers on this channel. And if it's intriguing and you want to learn more, feel free to subscribe.